bringing inflation back down to 2% sustainably is our job. There's no ifs and buts about that.
On Wednesday, we will have new CPI inflation data, and we expect the headline number, which includes gas and food, to be highly elevated.
I do think earnings numbers will still come down quite a bit, and whether we end up with a recession or not, I think there's a good chance that markets will price that probability as being higher than they have done as yet.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Fresh 40-year high, U.S. inflation is set to rise the most since 1981. The IMF slashes its growth forecast. So close, Euro traders get out of their microscopes as the currency staves off parity with the dollar by 0.003 of a cent. Plus, Twitter hits back. The social network sues to force Musk to honor its $44 billion buyout. Happy CPI day to you all. Markets certainly trading in a tight range as we look to see what CPI will bring. Will it be an elevated price that nears 9%? Tom Porcelli over at RBC says that's certainly a possibility, and we might be talking about a 100 basis point hike if so. IEA report coming out. Just want to bring you those lines saying that the oil prices threaten the economy as demand growth slows. We currently are looking at NYMEX crude under $100 a barrel. That fell below that level yesterday, trading ever so slightly higher, but it still is holding below $100 a barrel. It is the demand concern that is filtering through these markets, especially with oil. But it might be a little bit of bad news as good news. We're looking at U.S. futures trade higher this morning, but Europe is falling, maybe playing a little bit of catch up with the U.S. session yesterday, down 0.8%. Euro dollar, that is flat to slightly down. We didn't reach parity. We were very, very close. In fact, so close, some data sources showed us going through the floor, but Bloomberg data shows us still above parity at a 20-year low. Will CPI, a strong dollar that follows from it, be the thing that pushes the euro down? Villeroy over at the ECB saying that they are keeping a close watch on the weak euro. Finally, nat gas, another thing that has been weighing on the euro and the euro area, higher for a second day by almost 3%. Let me show you what the map looks like in Europe, because we are seeing most sectors down today. Most of them are sort of the industrial ones. Again, the fear of demand rationing, certainly see that in Heathrow with them asking some airlines not to sell summer tickets. Declines of mostly more than 1%. UK down more than 1%. DAX down more than 1%, as is Italy as well. So some risk aversion. But again, the big data point today is the CPI. That could change things for these markets. It's the data for June. It's expected this afternoon and expected to hit another fresh 40-year high. Now, that will likely see the Fed stick to its target of 75 basis points, or at least an aggressive hiking path. Taming inflation is the central bank's top priority, as Richmond Fed President Thomas Barkin emphasized when speaking in North Carolina.
We're engaged in a very challenging exercise, which is to try to cool the economy down to normal levels, right, in an effort to bring inflation under control, but without the intent of trying to cool it so down that the decline is calamitous. The right policy is to get inflation under control, period.
That was Thomas Barkin there speaking in North Carolina. We're joined now by Rebecca Chesworth, Senior Equity Strategist at State Street. Rebecca, thanks so much for joining. So I want to kick it off here. There feels to be this big differing of opinion when it comes to the direction of U.S. stocks when it comes to this earnings season. We have some banks saying, Citi, Bernstein saying, look, we've completely factored in weakening earnings. We also had Deutsche Bank recently saying that. Morgan Stanley, of course, a standout saying it will be an earnings shock. Where do you come down on this?
I think earnings are terribly important. So once we get beyond this CPI print, and I know that's been the news already this morning, that will be what drives the market from here. So we're in a market where people have gone short, and a lot of institutional investors have gone back to neutral. So I think there's some support to the market, but thereon in, that next step down could be driven by earnings. And where we are is we have a disconnect. So we've got a lot of people, economists, strategists, anyone looking top down, who are saying these earnings come down. But then, as you suggested, there's a lot of hype about what goes down bottom up, and I think the analysts are waiting to hear what the companies are actually going to say.
Well, we have started to see some cuts. I think it's something like 500 downgrades, net downgrades in the past week. That doesn't include just earnings. It's also price targets, those sorts of things. So are we starting to see that change in sentiment, or is it we're just going to wait and see and be optimistic until we do see?
So we're seeing the change in sentiment. So as you say, those net revisions are down, but they're still quite small so far. And really we're seeing then across the board, except for energy, really what people want to see is a little bit more precision. You know, is the consumer being hit more in some areas than others? Is consumer being hit more by industrials, etc.? So I think it's definitely that news flow really starts on Thursday, tomorrow, with the banks, and there on in, it's going to be busy.
How are you feeling about the banks? I mean, pretty cheap valuations at this point.
Banks is a very interesting area. It's one we get asked about a lot. And sitting on that ETF side, we've seen huge outflows this year from banks and financial ETFs. I think this is at the time that maybe we start to see that change, because obviously rates are top of the agenda. But I tend to think that those European banks, which are much cheaper, which are going to face a positive rate for the first time in decades, that could be much more interesting than in the US.
I mean, we still see a yield curve that it's at its most negative since 2017 or thereabouts. I mean, can banks outperform in the U.S. if we are faced with that macro impact of a negative yield curve?
It's difficult. I must admit it's difficult for them. So there are two things that affect. One is the overall level of yields, and that is going up. But then that inversion does cause problems, which is why I would therefore prefer to look at Europe at the moment.
Yeah, we definitely have to circle back to CPI. Obviously, the number today. It is a strange environment where all of a sudden we're trading on these singular data releases. We're trading on University of Michigan sentiment. It feels like a crazy world, Rebecca. I mean, how much volatility are we going to see from now on out? Is this the new world?
I know, I'm surprised. You look at the VIX close last night, I think it was 26, average for the year. It feels higher. It feels higher. We know that clients are sitting on their hands because we know they want to wait to see what happens. And I think we'll just move, as you said, we move from University of Michigan, then we move to NFP, then we move to US CPI. Apart from the earnings, I think we'll then find another data point. I think it's going to be difficult all summer because, of course, liquidity always falls during the summer as well.
How bad is liquidity right now?
We're not seeing any actual impact on funds trading, which is very good news. But I think it remains a long-term factor. So some people who would have naturally bought on weakness every time will start to think about that, and it might start to constrain their behaviours in the future.
All right, Rebecca, stick around. I want to ask about some of the dip buying since you have such a good insight into the ETF world. So stay there. That's Rebecca Chesworth, Senior Equity Strategist at State Street. Coming up, UK politics and the economy in focus. We're going to dive deeper into the latest GDP figures and who will become the Conservatives' next party leader. All of that to come. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Risk sentiment continuing to deteriorate about an hour into the cash equity trading. European stocks down about 1%. Nearly every single sector is negative today except for real estate and retail. Auto parts, one of the worst. It's those higher beta sectors which seem to be taking it on the chin today. We are looking at energy prices going higher, so perhaps those fears of economic impact, maybe even more demand rationing to come. Now, within all that picture is the UK economy. It actually grew more than expected in May. That followed 2 months of declines. A strong rebound in health services, that offset a drop in hospitality and consumer-facing services. GDP at the same time rose 0.5%. That was after a 0.2% decline in April. Economists had expected worse. They'd expected growth of 0.1%. The Bank of England's governor says, among all of this, it will act on rates if necessary.
There are more options on the table than just another 25 basis points. And those options can go both ways. We've had no growth, effectively, in private sector GDP. We've had very little growth, overall. And so I reject the notion that we've somehow stoked up domestic demand. What we have had, however, so you may say, well, yeah, that's all very nice, but how do you get the inflation? What we have had is a series of very big supply shocks.
Of course, Andrew Bailey there speaking before we had the release of the GDP figures this morning. Let's dig into it. Joining us is Bloomberg's Lizzie Burden. So, Lizzie, a bit of an upside surprise for this.
Yeah, significant upside surprise and, more importantly, a return to growth for the UK economy. So, as you say, it's driven by health, people going back to the doctor, offsetting the wind down of the COVID vaccination programme and the test and trace programme. So this is likely to embolden Rishi Sunak in his race to be the next Tory leader and Prime Minister, because he can point to the fiscal support that he provided as Chancellor. It's funny that his successor, I should say, as Chancellor, Nadhim Zahawi, has commented on these figures and said we shouldn't be complacent. But it will also likely embolden the Bank of England, perhaps even to go for a half-point rate hike in August. Because you heard Andrew Bailey there. He said last night that the bank is willing to do, there's no ifs, no buts about getting inflation back to its 2% target. So some had already interpreted that as seeing the bank willing even to spark a recession to get inflation back under control. This data show that the economy is doing better than we had thought.
Yeah, so perhaps can handle that more than a 0.25% hike. You mentioned the UK Conservative leadership race. Rishi Sunak, perhaps this will support him. I find that really fascinating. So what does that mean, though, for where this race goes? What's next now that we have our candidates?
Well, Sunak's the front runner. There are 8 candidates on the starting line. Of course, Grant Shapps, the Transport Secretary, has dropped out, as has the Health Secretary, former Health Secretary Sajid Javid. He maybe should have stayed because these figures worked to his favour, but with all the doctors' action. And then Raymond Shishti has gone too, who you might never have even had on your radar. But the next stage is the first round of voting. So we'll have the result by 5 p.m. To get through that, the candidates need at least 30 backers and not to come last. Then you'll have the second round on Thursday, the TV debates over the weekend, and then it should be whittled down to 2 candidates by July 21st to be put to the grassroots membership to vote on, with a new leader in post by September the 5th. But for now, Danny, it's very much focused on tax. The Resolution Foundation think tank has come out overnight and criticised the government being essentially in denial about Britain's long-term economic decline, and Labour is attacking the candidates on their economic competence, because really it's only Rishi Sunak who's saying that let's not launch into tax cuts until inflation's under control. But with all this call for tax cuts, even that could embolden the Bank of England to go for bigger rate rises.
All right, Lizzie, thank you very much. That's our very own Lizzie Burden. And Rebecca Chesworth is still with us, Senior Equity Strategist at State Street. Rebecca, you've been constructive on UK stocks. Just looking at the numbers, down 3% year to date. That compares to down 15% for the stock 600, 20% for U.S. So with that outperformance, can the UK equity market hang on to it?
I think so. So we've heard from Lizzie this morning about those PMIs. That's the good news. Then you had before that the Andrew Bailey clip.
Sure.
That's the bad news, really. Rates carry on rising. But really, when we think about the UK market, this is quite a comment I always make, is the UK market is not the UK economy. We're a very global stock market with the FTSE. And what you see within the FTSE all-share and the makeup of it is the strength of energy. So we're overweight energy, we're overweight miners. They are areas which we still think will outperform before the end of the year. And then we've got a large defensive bias as well. So we've got those large healthcare companies, we've got those large consumer staples companies. All of that, I think, will help the market to perform relatively well against the rest of the world.
Well, we have seen some of these inflationary bets start to come off, at least when you look at things like break-evens. With that in mind, looking at oil falling on demand concerns, can energy stocks continue to be sort of the port in this storm that we've had this year?
Yeah, I mean, the energy story is changing the whole time, but I think we haven't resolved the global supply oil shock.
Right.
And, you know, if we just think what we've heard in the last 24 hours, we've had the IEA and we've had OPEC Plus saying, you know, the supply crunch has not gone away. So, yes, that crude oil price did come back below $100 per barrel yesterday, and that is a key measure, and that means that forecast upgrades won't be as large as maybe we were thinking. But with inflation still a key issue, and given that we're going to be talking about the CPI this afternoon, then you need that inflation beneficiary in your portfolio still, because maybe that's the only thing that really holds its level, where everything else starts to struggle a bit more.
Well, perhaps to save us from what I'm sure is just going to be an all CPI, all things afternoon, I do want to ask you about tech, Rebecca. I was talking to you during the break that I was surprised to see that the ARK ETF had inflows year to date. Now, Bank of America once described this as the Pavlovian urge to buy buy the dip. When you're looking at ETFs, when you're looking at State Street's great selection of SPDR ETFs, do you still see people willing to buy the dip, especially that retail audience? We do. So as I mentioned earlier, one worry is that people won't do that, but we do see that. And just in the last couple of days, we're seeing those tech flows come back and those consumer discretionary, because they're very, very important parts of the US economy. Now, personally, that wouldn't be a pick of mine for the next quarter, but I can really understand people wanting to put money in at this levels, especially if you have that long-term mindset and you can, see it through another couple of what may be difficult months. Yeah, I did hear some concern that perhaps that's not there, that pillar of support. Is it still a pillar of support of mom and pop type buyers in the ETF market for, again, the overall equity market? In the US, yes. Okay. In the US, that retail investor makes up a huge percentage. But actually, in Europe, we tend to be a lot more institutionally focused now. So there are different dynamics to watch there. All right, Rebecca, thanks so much. Glad we got some of your ETF expertise in there as well. Rebecca Chesworth, Senior Equity Strategist at State Street. Let's get to some of our top stories with the Bloomberg First Word News. It's Leanne Gerrans. Hi, Leanne.
Hi, Danny. Sri Lanka has imposed a state of emergency across the island and a curfew in the western province as police clash with demonstrators. A Bloomberg News photographer in Colombo says protesters are entering the Prime Minister's office. This comes after Sri Lanka's president fled the country earlier on a military jet. Now, the IMF has cut its growth projections for the US economy for this year and next after just a month. It has also raised its unemployment estimates to 2025, warning that a broad-based surge in inflation poses systemic risks to both the country and the global economy. The IMF expects GDP to expand 2.3% this year, down from 2.9% it projected before. Now, Shanghai's COVID cases appear to be leveling off following a recent spike, though some residents have been urged to stockpile food and medicines as lockdown fears hang over the city. The Financial Hub reported 55 new infections for Tuesday, all found in people who have already been quarantined, a compulsory measure for cases and their close contacts over in China. The US Bureau of Labor Statistics says a June inflation release circulating online is a forgery. Stocks slumped to session lows around the time the fake release started making the rounds on social media. The release attempted to mimic the formatting of the prior month's CPI report, but with different dates and numbers, including some errors. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thanks so much. Now, coming up on the program, Twitter's $44 billion legal drama carries on. We'll have the details for you next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, Sri Lanka had imposed a state of emergency. That was after the president had fled. A new temporary acting president was put in place. Now, breaking lines, protesters have seized Sri Lanka's state broadcaster. This, of course, follows many protests, a lot of discontent in Sri Lanka over high energy prices, over inflation. Again, it's a general macro story of the concern there, but really acute in Sri Lanka. So again, protesters having seized Sri Lanka's state broadcaster. We'll keep you on top of those lines as they come. Let's take a pause on that and now move to Twitter. It's a blockbuster legal battle underway after Twitter filed suit against Elon Musk over his abandoned $44 billion takeover. Lawyers told a Delaware judge that the world's richest person changed his mind, trashed the company, and then walked away. Musk blames Twitter for not providing enough data on fake accounts. Joining us now is Bloomberg Quick Take's Alex Webb. Alex, okay, you've looked at the filing here from Twitter. What would you say are some of the main takeaways of their argument for why Elon Musk must carry this deal to the finish line?
They really are throwing the kitchen sink. There's a very rich document, loads of points they're making, but above all, the things that jumped out at me was they said that Elon sometimes didn't turn up for meetings. They said Elon admitted at a certain stage that he hadn't read the documents they'd sent him about the, how they calculated the bots and how many bots there are. And thirdly, maybe this is unsurprising, but they use his tweets in the filings. In fact, they even use tweets that have been published this week as evidence for why he's perhaps not being sincere, or why they think that it is not just that he's trying to walk away from the deal.
Feels so incredibly meta for a Twitter lawsuit filing to be using someone's tweets against them. What are Elon Musk's chances to win this, to be able to walk away?
It certainly looks quite slim. Now, I'm not going to make a call and say it's absolutely not going to happen, but if he walks away, I can't see just being able to walk away scot-free. Whatever happens, he'll have to pay the $1 billion breakup fee, presumably, but I think it's highly unlikely that he wins. The case law, where this material adverse effect, material adverse charge, that's the thing he's leaning on, the notion that something changed in the understanding of the company, in the market, or the data wasn't complete. The Delaware Chancery Court has only ever allowed one deal to be walked away from in sort of 25 years. Kind of suggests that it's going to be very hard for him, particularly given the way that things have been phrased in his filing. It doesn't say, like, Twitter doesn't have the same number of bots that he says. He says Elon believes he doesn't, so it's like different phrasing.
Yeah, so very careful with the language, it seems there. Alex, thank you very much. That's Alex Webb from the Bloomberg Quick Take team. Now, coming up, walking a tightrope, central banks balance control inflation and avoiding a recession. Ahead of CPI, we're going to get Standard Chartered's tips on how investors can best navigate the uncertainty. This is Bloomberg. Fresh 40-year high, U.S. inflation is set to rise the most since 1981. The IMF slashes its growth forecast. So close, Euro traders get out their microscopes as the currency staves off parity with the dollar by 0.003 of a cent. Plus, Twitter hits back. The social network sues to force Elon Musk to honor his $44 billion buyout. Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Francine Lacqua is out this week. Continuing, though, to look at equities which are selling off in the European session, around about the lows of the session, down 0.9%. Most sectors in the red this morning. We're again waiting for that CPI print. Tom Purcelli over at RBC says it could be 9% or just there under. And if it does, we could be talking about 100 basis point hikes. So perhaps not a big willingness to put on trades ahead of that figure, but we are seeing the commodity complex move higher. Brent crude, though, still below $100 a barrel. NYMEX crude, I should say. That was after the sell-off yesterday. Concerns about demand. Nat gas, that's moving higher, 5% higher so far this morning. Those are Dutch front-month futures. Nord Stream down, it's down for maintenance. Is this what Russia uses as an excuse to stop the flows? That certainly has been one factor beating up the euro. Still above parity, but not far from it. Now, central bankers, they're walking a fine line between controlling inflation and avoiding a recession. Standard Chartered sees inflation easing only gradually and the Fed maintaining its aggressive stance. The man behind that view, Chief Investment Strategist Steve Brice, he believes raising allocations to bonds and tilting towards Asia and UK equities are the best way to navigate this tightrope. And he joins us now. Steve, thanks so much for being on the program with us. So I got to start here. Your note from the 24th of last month, bearish dollar, bullish euro. Are you still hanging on to that call?
Yes, I mean, this is a longer term view, right? So over the next 6 to 12 months, we sort of see the peak Fed coming in. So obviously that's difficult to see at the moment, particularly with the inflation print that's due tonight. But overall, we're saying that we will see inflation come down, base effects coming through, obviously some of the supply side pressures easing. And that will allow, ultimately, the Fed to start backing off from its aggressive rate hiking cycle. We're obviously not in July. We're still thinking we're going to see 75 basis points. But if you step back and say, has the Fed achieved its goal? And that sounds really strange. But if you look at long-term inflation expectations, they've already hammered those back to where they probably need them to be. So from the five-year down from 2.6 to around 2%. So that's obviously consistent with their long-term inflation goal. Now, inflation's been politicized. So, and within short-term inflation where it is, there's nothing they can do. They still have to hike. But if we do see that downtrend coming through in inflation in the coming months, then I think that will allow them to back off.
So is this sort of a natural coming down of inflation? I asked you, because there's this political element. Does that mean that the Fed talking about jumbo rate hikes, 75 basis points, that at this point is just this image game, this game of catch-up? It's not actually necessary to cool inflation?
I think they have to say that because they've been criticized so heavily for being behind the curve in inverted commas, right? So, and if they were weren't aggressive now, the risks for them politically are just so great, right? So they still have to be very aggressive. They have to talk very aggressive until it becomes very clear that inflation is coming off. So I think they have very little choice. I think that it does increase the risks to the global economy, of course, right? So we have a 40% probability of a recession in the US in the next 12 months, and that's the fly in the ointment. I think you would talk about it when you look at oil prices, etc. That is something that we just need to keep a very close eye on.
So your long-term view is one of this shift back to inflation starting to slowly come down, but we're about to get a CPI report that expectations are around 8.8%. How are you finding safety until we get to your base case scenario?
So, I mean, to be honest, we do have an overweight to gold, but that obviously gold broke lower last week, right?
Yeah.
So I mean, it worked really well for us at the beginning of the year, but obviously become a little bit more challenging in recent times. So the way we look at it, so we're pretty neutral across level 1 asset classes, so equities and bonds. We've increased our allocation to bonds but on that growth slowdown view, so peaking rates, peaking yields. So we think that's an interesting opportunity for investors. Within equities, we're looking at places that actually are either protected from the economic cycle a little bit, or maybe even actually in a different part of the economic cycle. So we're overweight Asia ex-Japan equities because we believe that we're going to see China continue to stimulate the economy. As it comes out of lockdowns, then we're going to see the credit creation pick up, and that leads to stronger economic and earnings growth. So, so we're overweight Asia ex-Japan.
Are you willing to be bullish Europe at this moment, given the concerns around energy, around the pipeline, around Nord Stream?
I think it's difficult at the moment, obviously. It's often when sentiment is so poor, it's a great time actually to be bullish. So, you know, we're not sort of saying, no, now we need to get totally out or anything like that. But it is difficult to see how Europe is going to suddenly improve the situation. So, you know, you have to say with where the euro is, parity looks like it's going to be breached. I know we were incredibly close yesterday. We're still pretty close today, right?
Definitely.
So we could still see another leg down in the euro in the short term. But it is pretty difficult to be bullish in the short term.
Well, so you are bullish high yield. I wonder what you make of Marko Kolanovic saying that, look, equities, this is U.S. equities, they've mostly priced in a recession, perhaps too far, but high yield bonds, credit, they have yet to do that. So he recommended taking exposure off. Do you think that's wrong then? So
we're the reverse, right? Actually, so we'd agree on the equities piece, right?
Okay.
So if you look at the average pullback in equities during a U.S. recession, it's 27% since the 1950s. Obviously, the last two have been more severe, but then that was a global financial crisis and COVID, right? So they were deep,
right,
even short-lived in COVID's case, recessions, right, and financial challenges induced as well. So they were much sharper, but historically it's been 27% on average. If you get a shallow recession, we've seen peak to trough of 24% already, so that's pretty much priced in. So we'd agree on that side. However, we also think that high yields price in quite a lot of bad news already. If you look at the yield on high yield bonds today over the past 12 and a half years, we're at the highs, right? So spreads have widened significantly. You're pricing in default rates of around 5%. And we don't think that in the recession, even if we do get that shallow recession, we're going to see that spike. So we think good value is actually there today.
Yeah, well, you're sounding a lot, I have to say, like Rick Reeder over at BlackRock, who does say, look, credit's safe. Default rates are going to be really low, but that brings me to this other conundrum of the current environment we live in. What's happening with the cycle we're in right now? Are we in completely uncharted waters that we're just skipping the default cycle while at the same time we're talking about 40% odds of a recession?
Well, I mean, you could argue that we're actually getting defaults through inflation. Right, so the real value of debt is going down just because people will pay them in money that has been depreciated in real value, right? So you're actually seeing that through, and that should limit the default cycle as well, because then your earnings are going up, your cash flows are improving just because you're getting that inflation. So that should limit the down cycle, unless you're sort of saying, okay, interest rates are going to 5-7%, then that could be a very different environment. But that's, you know, in our view, we'll probably get up to 3.5% on the Fed funds, and then probably peak out. So from that perspective, yeah, credit looks good.
So I want to end here. You have your longer-term themes, and one of them is this one of China. And tech has been extremely volatile in China around regulation, especially. Is this one of the long-term themes? Do you see that easing up and that being an attractive area?
So I think there's two things, right? So on the regulation side, we do believe that we're seeing peak regulation already in China. So they are still very committal to their 5.5% growth forecast. That looks like a pipe dream, to be honest, today, given that the market is expecting around 4.3%. So we think we're going to be stronger than 4.3%, but 5.5% looks really challenging to hit. So I think the regulation, they really will back off on the regulatory side. They're also this China Common Prosperity theme of being self-sufficient. So you're seeing the geopolitical environment is very challenging. China acknowledges its reliance on the US and US technology. I think they want to break that down. So the technology sector is actually probably front and center of what they want to achieve. But that's technology, not necessarily communication services. That's very different.
Fair enough.
So.
All right, Steve, thanks for stopping by and visiting. Steve Brice, Chief Investment Officer at Standard Chartered Bank. Coming up, U.S. President Joe Biden embarks on a 4-day tour of the Middle East. We're going to have the latest from Israel next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London. Equity is on the back foot this morning, but there is a lot of wait and see for what's expected to be another 40-year high in the CPI print later today. Tom Porcelli, RBC, says, look, it could be just under 9%. That could see the Fed go 100 basis points, or at least we might start to have the conversation about that. We were just talking to Steve Brice over at Standard Chartered, who said that, look, inflation will start to come down. The Fed is aggressive for now because they're playing this game of catch-up. But on the long haul, it would be one where you want to go back into bonds. The yields, they might have peaked out. But throughout Europe, you can see negativity. FTSE 100, that's down 1%. A little bit better performing from the CAC 40. That's down 0.5%. The DAX also weak. Auto is one of the worst performing sectors. The higher beta sectors, the more cyclically associated ones, those are the ones that are performing the worst today. We're looking at energy prices in Europe. Those are moving higher, so that could have that impact of selling equities, at least in Europe. But again, will the CPI print turn that around? Will the CPI print be the thing that finally takes euro to parity? 1.0034. That's where we stand on the euro dollar. Let's get to some of our top stories now with your Bloomberg Business Flash is Leanne Gerrans. Good morning, Leanne.
Hi, Danny. Google plans to slow hiring for the rest of the year in the face of a potential recession. CEO Sundar Pichai emailed staff saying the company will focus hiring engineering and technical staff this year and next. He also called on employees to be more entrepreneurial and to work with more hunger. Now, Peloton shares jumped after it said it will stop building exercise bikes and treadmills at its own factories and rely on production partners instead. It's part of a shift to cut costs and streamline strategy at the fitness company. Peloton did boom during the pandemic, but has struggled as gyms and economies reopened. And finally, the Netflix hit Squid Game will compete for Best Drama at the Emmy Awards in September. It is the first time a foreign language program has been nominated for the biggest prize in the US TV industry. The show is the most popular in Netflix history and will be up against the likes of HBO Succession and Euphoria. And that's your Bloomberg Business Flash. Squid Game 2 out soon, Danny.
I'm not sure that my heart can take another Squid Games. Great show, but made me not sleep for a week. Leanne, thanks so much. All right, on to more serious matters. Joe Biden begins his first trip to the Middle East since becoming president. He'll first land in Israel. He'll meet with Israeli government officials as well as leaders in the West Bank. But the visit risks political embarrassment at home unless he's able to bring near-record gasoline prices down. Joining us from Tel Aviv, is Bloomberg's Daniel Avis. So, Daniel, obviously this is the first stop on a wider Middle East tour from Biden. What is Biden hoping to do to get out of this visit to Israel?
Yeah, absolutely. Thanks for having me on, Danny. So, as you mentioned, this is the first stop in Biden's inaugural visit to the Middle East. From here, he'll go on to Saudi Arabia for talks with King Salman and Crown Prince Mohammed bin Salman. But while he's here, he's spoken of a desire to integrate Israel further into the region, to sort of state that America is re-engaging with the region as well. But there's no getting away, as you say, from those tough economic numbers back home. Obviously, gas is still incredibly high at the petrol pump, and CPI very high as well, 40-year highs, and possibly even higher today. Those figures, interestingly, are due to arrive at around the same time as the US president here in Israel. And so we could well be in a situation where, as well as being greeted by the Prime Minister, by the President, he'll also be received by some quite unpleasant economic news, I think it's fair to say.
Well, tell me about the other side of this trip in Israel. What do the Israelis want out of this visit from Biden?
Absolutely. So, Israel has a new prime minister, Yair Lapid. He's been in place for just a few weeks now after the collapse of the former government. Israel's heading into its 5th elections in 4 years in November. So for him, he'll be very happy to burnish his credentials on the international stage. In terms of what the Israelis want from the Americans, there's talk of some sort of joint communique possibly being signed, which states very clearly the US and Israel opposition to Iran ever acquiring a nuclear weapon, and also guaranteeing Israel's freedom to operate in the region to protect its interests. There's also likely to be some sort of agreement on academic collaboration in the areas of artificial intelligence, quantum computing, things like that, and possibly also discussions around Israel joining the US visa waiver program, something that they've long wanted to do.
Daniel, tell me about what this visit could mean when it comes to Israeli bilateral relations with Saudi. What does that mean in terms of course, Biden trying to get more oil production out of Saudi, trying to repair those relationships? What will this do to that?
Sure. So as you say, after this visit, Biden's due to go to Jeddah. He's due to fly directly from Tel Aviv to Jeddah, the first time that such a trip will be made by a sitting US president. And so that visit really will deal with the question of oil. But in terms of that bilateral relationship, there is talk possibly of some gradual step in the direction of normalization between Israel and Saudi Arabia, a very different sort of pace to Israel's normalization with the United Arab Emirates, with Bahrain, with Morocco back in 2020 under President Trump. Things that are being discussed, possibly overflight rights over Saudi airspace. So for commercial airlines traveling to and from Tel Aviv, instead of having to go around Saudi Arabia, they'll be able to fly directly over the kingdom, which will mean places like Southeast Asia, East Asia, and possibly even Australia will become possible destinations for direct flights from Tel Aviv. So that's one possibility. There's another discussion around the possibility of integration, further integration of Israel into the security architecture of the region, which may well lead to some sort of joint communique that would mention Israel and Saudi Arabia in the same sentence. But as I say, gradual steps, and that's in large part because Saudi Arabia continues to publicly state that there can be no real normalization with Israel until there is some significant progress made on the issue of peace with the Palestinians, something that neither the Israelis nor the Palestinians are hopeful of ahead of the Biden visit later today.
Yeah, Daniel, why don't you just wrap it up for us? Is there anything else on this agenda that we should be watching out for on the trip?
In terms of the broader Middle East trip, obviously, as I say, Biden is here for a few days. While he's here, he'll meet with the Prime Minister, he'll meet with the President, he'll meet with opposition leader Benjamin Netanyahu, who would very much like to return to power after a year out. And he'll also meet with Palestinian Authority President Mahmoud Abbas. As I mentioned, unlikely to be any significant progress made on that issue, but there could be some announcements made around improving economic conditions for Palestinians living in the West Bank. And then, of course, he'll get back to the airport, get on that plane to Jeddah for that all-important meeting with the Saudi King and Crown Prince, and also a wider meeting of what's known as the GCC +3, so the GCC plus Iraq, Jordan and Egypt. And that meeting is likely to deal with a range of regional security issues as well.
All right, Daniel, thank you very much. Bloomberg's Daniel Avis in Tel Aviv. Now, markets, we are looking at some bond buying happening. There is some bull flattening of the curve. We're looking at the most negative yield curve, the most inverted since 2007. That continues on. Elsewhere, there are some risk appetites diminishing throughout the equity market. In Europe, we're near the lows for the day, down about 0.6%. It was down about 1%, so not as bad. But again, it's a lot of wait and see ahead of that CPI report. A CPI report where if it's very strong, could see that bid come back into the dollar and the euro yet again get closer to parity. We missed it by just a whisker yesterday. Some data sources even showing us dropping through that floor of 1 to 1. But at the moment, we are at 1.0026 on the euro versus the dollar. There are concerns about the gas crisis in Europe. You can see energy prices moving higher for a second day. That's the last one there. That's Dutch front month futures. Europe natural gas futures up 6.2%. Nord Stream 2, that is down for maintenance. Is that what Russia uses as an excuse to cut off the gas flows? That could cause even higher inflation, economic woes, and thus That's how we get to euro parity. Sinking even further, Jordan Rochester says 90 cents could possibly be the floor. And there you go. That's 2s, 10s, what I was mentioning. Most negative since 2007. Is that the sign, the strong sign that we've been waiting for, that a recession is on its way, or perhaps it is already here? Now, coming up, London Heathrow imposes a cap on daily passenger traffic, struggling with surging demand for travel. That story next. This is Bloomberg.
But on a macro scale for the UK, it's going to lead to a summer of discontent. It could lead to higher wages, more broadly speaking, and that makes life trickier for the central banks. They're looking at high inflation, looking at rising wages. They should be raising rates in that scenario. But they're also seeing economic crisis building up in the future, in their pipeline. We have, especially if the gas situation gets worse.
Jordan Rochester there from Nomura talking about flight cancellations from Heathrow, predicting a summer of discontent. Now, it's all that travel chaos contributing to it. London Heathrow is imposing a 2-month cap on daily passenger traffic to contain flight chaos. It's a dramatic response by the UK's busiest airport to address the struggle with surging demand for travel. Joining us now is Bloomberg's Leanne Gerrans to get into it. Leanne, so what do we know so far about this passenger cap?
So we know that Heathrow is saying 100,000 daily passengers, and that's it, no more. And what we know is, according to the latest forecast, they're saying it will be 104,000 people are going to be passing through the airport. And I spoke to Heathrow yesterday, and they said to me it's that 4,000 that is the sticking point, because obviously they have been suffering with staff shortages. And this is due to the pandemic, Danny. You know, so many staff were laid off during this time, and now rehiring has been a real issue. But Heathrow feel that this is the best way to make it safe for travellers to get through the airport. And we spoke to Manus yesterday, and he was like, there's just baggage everywhere. So it's also to stop all of that frustration.
You know, it's interesting. Heathrow is obviously top of mind for us since it's close to you and I. We travel from it. Probably a lot of our viewers do as well internationally. But we were just talking about this during the break. I mean, it's not even Heathrow that's the worst when it comes to delays, is it?
Yeah, no, I was really surprised by this. So a new survey came out today from Hopper, and it was basically saying that Heathrow Airport, we are seeing all these delays, all this chaos there, but it's only ranked 15th as the worst airport in Europe for delays. Luton is actually ranked 4th, so it was worse. And actually the first ranked for delays and chaos is Brussels Airport. So Heathrow is actually ranked 15th, just to remember that. But I want to have a look forward to all of this, because we must remember one thing. It's all about staffing shortages, and what the airlines are trying to do now is, you know, escalate that and get more staff in. But because it's all about security checks and controls, it's not as easy as possible. And we talked about this being the revenge summer. So many people want to go after the pandemic. They want to travel abroad. But, you know, people and flights, there's just unfolding chaos, really. And what we need to remember is this will all sort itself out. But Heathrow are doing this at the moment, and they're saying there'll be another 2 months of discontent.
Yeah, and you can see that pressure in IAG share prices. You pointed this out to me earlier, down 3%. Certainly concerned that demand rationing is going to hit the airlines. Leanne, thanks so much. That's our Leanne Gerrans with the latest on the travel story. Bloomberg Surveillance continues in the next hour. Matt Miller and Kailey Leinz in New York, Anna Edwards out of London. This is Bloomberg.
Market is very long dollars right now.
The US equity market is part of that story. It's already signaling that things are going to get worse. The question is how much worse and how quickly.
We're going to see a lot of business models really challenged, and that's where you'll have something breaks.
I'm not sure that we will see disruption from this slowdown in the economy.
There's a lot of pent-up demand. Retailers are getting consumers used to the fact that inflation is building, and some of that and more of that will be passed on to them.
I think on the inflation front, I think we're winning the war.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
Good morning. It is 5 a.m. here in New York, 10 a.m. in London, and 5 p.m. in Hong Kong. Welcome to Bloomberg Surveillance, the early edition. I'm Matt Miller with Kailey Leinz in New York. Anna Edwards with us out of London. Our top stories today: inflation in the U.S. probably set a new four-decade high last month. That will keep the Fed on track for another big rate hike. And it's all about the oil. President Biden is on his way to the Middle East, where he'll try to persuade Saudi Arabia to boost crude output. Plus, Twitter takes Elon Musk to court over his scrapped $44 billion buyout. Meanwhile, Google is putting the brakes on hiring. So there's a lot going on today, but we are really focused first and foremost, Kailey, on inflation. What do you see in terms of the Asian markets in preparation?
Well, of course, they closed before we get that data in about 3.5 hours time. But all said, it was a modest update in Asia overall. The MSCI Asia Pacific Index higher by about 1/3%. Interestingly, a major outperformer was Taiwan. Stocks there up 2.7% after authorities pledged to support the domestic markets in a way they haven't done since the onset of the pandemic, really, in 2020. Of course, the Taiwan benchmark index was down 25% year to date before today. So now some intervention coming in to try and stem those losses. In other asset classes, foreign exchange in particular, your big outperformer in Asia today is the South Korean won, after the Bank of Korea delivered a jumbo hike, a record 50 basis point hike, following on the lead from other central banks. It also pledged to tighten policy further to fight inflation. So as a result, the South Korean won stronger against the dollar by about 0.4%. Final note in the commodities complex, I wanted to point to palm oil because futures were down another 5% overnight. They are now at their lowest level going back about a year. On the one hand, you have concerns about demand broadly in some of those crop spaces, and also potentially an inventory glut in Malaysia in particular. So that weighing on those futures overnight, Anna.
Yeah, and in fact, a lot of weakness in commodities to speak of overnight, Kailey. Let's focus in on the European story, and European equity markets are weaker this morning, factoring in a bit of the later in the day net nervousness on Wall Street yesterday. And so European equity markets move lower, cautious, waiting for that US CPI print. We got confirmation of some of the European relatively high inflation data. We got confirmation of that in the early part of today's session. I've got a couple of currencies that aren't really moving very much today, but certainly interesting stories to talk about. The parity party then on euro dollar, well, that had to wait. We didn't get there yesterday. We're a little way from it today, only a fraction away, of course. 1.0033. The 21st of July is now seen by investors as going to be a really important day. We get to hear from the ECB that day, but that is also the day that the flow of gas is supposed to be turned back on from Russia into Europe, and a lot of investors are saying that that latter point is actually going to dominate and perhaps be more important than the former. The pound, I also put this in because 118 is where we trade on cable. We got the GDP data out from the UK, and there are some difficulties with interpreting the data because of the movement of a public holiday, but essentially the data was better than had been anticipated. But will it be enough? There were some warning signs around the consumer in that data if you were looking for them, and that perhaps doesn't bode well for the future. And I also put in JD Wetherspoons, affectionately known as Spoons. Matt, you may have heard of it here in the UK. It is a pub chain, and yeah, I know he has. We've talked to the CEO a number of times. Anyway, a profit warning from them. It seems that the pent-up demand that they were expecting to see post-lockdowns for pubs in the UK has not quite materialised. Maybe all their potential customers are stuck at airports or just trying to keep cool somewhere. Maybe they should advertise their air conditioning.
Tim's a great guy, and I love the pub. No secret there. Anna, I'm looking at S&P futures that are higher today, and this is interesting to me because the last time we got an inflation print, remember that CPI that was 8.6% on June 10th, we lost a solid 200 points on the S&P index in the next two sessions. Actually, I think like 225. We were down 2% on that Friday. We were down 4% on the Monday following. So it was a show in terms of what happened to markets. 10-year yield right now holding just below 3%, 2.9576 as investors seek a little bit of safety in government debt. NYMEX crude is up a little bit, but still at 97.14. Had a big drop yesterday below $100, and it's holding down there. And then Bitcoin, right now at 19,818. Remember what happened last time we got an inflation print? We were hovering around 30,000 for so long that I wanted to take Bitcoin off the board. It dropped by $10,000, by a third in less than a week following that inflation print. So watch Bitcoin if we get a surprise to the upside today. Now, Of course, it is the main event. It isn't until 8:30 a.m. New York time. So we still have about 3.5 hours until CPI comes out. For more on what to expect, we're joined by Kriti Gupta, Bloomberg Markets correspondent. KG, what do you got?
Hi. Well, let's talk about the estimates here because we are asking once again the big question, has inflation peaked? Is it in the rearview mirror? That peak was supposed to come in March, Matt. We haven't actually seen that happen yet. And remember, these estimates right now, the CPI estimates, 8.8% year over year. The prior, remember, was 8.6%. If you put that and look at Wall Street, you actually start to see ranges for going 8.6%, the same as the prior, going all the way up to 8.9%. Even Bloomberg Economics saying that they could go as high. The big question here is this the highest? And there is, I think, a little bit of a consensus that we probably haven't seen the peak here.
Yeah, we thought we had seen it before, and that was proven wrong last month. And of course, the Fed is focused on that headline number, even though Wall Street may pay attention to that core metric month on month. The Fed says ultimately food and gas is what the American people feel, so we have to react to it. At the same time as we await this data, we also have a yield curve, at least for 2s, 10s, the most inverted going back to 2007. Not a great signal.
Not a great signal, but it's across the curve. And you're seeing this in the 2s, 10s, 10s, 30s, which actually brings me to a terminal chart. For our radio audience, stick with me here. This is important. I'm bringing back an old favorite. David Ingles made this a Top Gun favorite, Top Gun reference for Matt Miller, for Kailey, for our producers, of course, saying I was inverted. But basically, we're looking at the 5s, 10s curve here, which in the last, I want to say year to date, really, has kind of bobbed in and out of inversion territory. And the reason I look at the 5s, 10s is the belly of the curve to kind of get this broader signal of really all those kind of maturities. And what you can see is this pricing in the market where you're not really sure if the Fed will actually hike into a recession, if inflation ends up becoming the straw that breaks the camel's back, in addition to the decelerating growth that's already there. So that's going to be certainly a metric that we keep our eye on. We also are going to keep an eye on the currency strength here because the dollar is really what matters. As we see those higher inflation reports, the idea here is that the Fed is going to go tougher and tougher, even more hawkish. Do you start to see that actually break the back of some of these other currencies? We're already talking about euro-dollar parity. We're already talking about record Japanese weakness and even the cable rate. Some people out there saying maybe start talking about cable parity. A lot of that is going to be a function of the dollar and what you see in today's inflation report, as well as the Fed's reaction, Anna.
We'll be watching our own maverick on the markets. Kriti Gupta, thank you very much with the latest there. Now, the IMF has cut its growth projections for the US economy this year and for next. It's warning that a broad-based surge in inflation poses systemic risks to both the country and the global economy. For more, we're joined by Enda Curran, Bloomberg Chief Asia Economics Correspondent. Is this the IMF slow to the downgrade party, Enda, or is it the pace at which they're downgrading their forecasts that's of interest here?
Well, it's certainly a sharp adjustment. They've cut their forecast from only 1 month ago, and they're now looking at growth in the US of 2.3% this year, down from 2.9%, and they're expecting unemployment to go up to around 3.7%. They also said that the authorities have to focus on getting inflation down, but they need to do so without causing a recession, which they say would be challenging. Now, they didn't give any particular reasons for the growth downgrade, but we do know, of course, that the consumer seems to be coming off the boil in the US. So perhaps the IMF is now trying to get ahead of the curve and signaling where these rate hikes will start to cause pain in a couple of months from now.
Okay, so that's the U.S. economy. Enda, let's talk about the Chinese economy as well, because we got trade data overnight and those exports.
Yeah, bumper exports, stronger than expected, up 18% in dollar terms. It reflects a number of things. It reflects the fact that the ports were able to reopen, the factories were able to reopen, as all of the restrictions around the Shanghai region lifted over the month of June. So it's clearly a strong number. A lot of economists saying, though, that demand won't hold up. Part of it is rebound due to the reopening, and partly as we go into later in the year, they expect Western consumers to start feeling the strain of those interest rate hikes and buying less Chinese goods. So I don't think anyone expects this export story to hold up. The PBOC were out this afternoon as well, and they made the point that the economy still continues to need support. So I don't think anyone's calling it kind of a V-shaped turnaround or anything just based on these trade data.
And thanks so much. Bloomberg's Enda Curran there talking to us about economic outlooks and data points. Now, President Biden's problems at home are looming over a Middle East trip that's all about oil. The president arrives today in Israel, the first stop on his agenda. Anne-Marie Horton, Bloomberg Washington correspondent, joins us now out of Jerusalem. And really, Anne-Marie, we're going to be focused on his ask to MBS later on in Saudi Arabia.
Yeah, he'll be in Jerusalem and the West Bank this week before he makes that trip over to Saudi Arabia. But Matt, you're right. That meeting with the Crown Prince Mohammed bin Salman and King Salman and the other Gulf leaders is really going to be the most significant part of the trip. And that's where everyone is watching to see, one, how the interaction is, because remember, this is a president who campaigned on making the kingdom a pariah. But also for the oil market, this is a big moment to see if the kingdom is willing to step in, maybe alongside the United Arab Emirates, to potentially help the president for his biggest problem at home, which is, of course, bringing gasoline prices down.
Anne-Marie, thanks very much. Bloomberg's Anne-Marie Horder joining us there from Jerusalem. She will, of course, bring us all of the latest as that trip continues to other countries as well. Now, in Sri Lanka, a state of emergency has been declared after the president fled the country. Protesters gathered outside the presidential palace following the president's departure for the Maldives. Ruth Pollard of Bloomberg Opinion joins us now from New Delhi with the latest. Ruth, we understand that the state broadcaster has now been captured and scenes described as tense around the prime minister or acting president's residence.
Yes, I mean, it's a very fluid situation in Colombo right now. There are heavily armed security forces in riot gear trying to protect these government buildings, but we're just getting reports that protesters have stormed the Prime Minister's office now and taken control of that. We understand the national broadcaster is back on air, but we now have an acting president in Ranil Wickremesinghe, who the protesters are also calling to resign. They've been protesting peacefully for months along Colombo's waterfront, and they see Wickremesinghe as just part of the political elite that has brought the country to its knees and caused this economic crisis. And they say they won't stop until Wickremesinghe also goes. So for now, the IMF talks that were underway will inevitably be delayed until there is a government in place. And right now, all we can see for this island is economic instability and a deep political crisis.
Ruth, thanks very much. Yes, this ongoing political and economic crisis will continue to bring you the latest. Ruth Pollard of Bloomberg Opinion. Some of the pictures, you know, we see protesters on the streets now. Some of the pictures you were looking at there were protesters over the weekend queuing, forming a line to try and visit the president's palace, which, of course, has already been stormed by protesters. Now, a blockbuster legal battle is formally underway, if we get through to the tech story, after Twitter filed a suit against Elon Musk over his abandoned $44 billion takeover offer. Bloomberg's Alex Webb joins us now with the details. Details then, Alex, on this. I mean, this is as expected, I suppose, this legal action being taken.
Yes, we knew this was coming. It was a very poorly kept secret, but the nature of what's in the filing is, of course, fascinating. Some of the accusations they're levying towards Elon, the idea that he apparently said that he hadn't read some of the documents they sent him, which outlined the bot situation, that he skipped some meetings. These sort of details are, you know, grist the mill to the idea that he might struggle in a court case. Of course, we're yet to see what his response might be. The only filings we've had so far from his side are the fact that he believes there are more bots on the platform. They haven't sort of said explicitly there are more bots on the platform. So there is some very finely picked language from the Elon side and a deluge of things from the Twitter side.
Well, and another argument Musk has made is that Twitter has failed to operate its normal course of business because, as we know, the company instituted a hiring freeze after the news of his planned buyout, which, of course, now is a question mark. And on the subject of hiring, we also heard from Google overnight they're slowing hiring for the rest of the year. The CEO saying, hey, we're also not immune to economic headwinds.
The thing we know is in recessionary environments or in economic slowdowns, the first thing that companies tend to cut is their advertising and marketing budget. And of course, these companies are fundamentally advertising companies. And so we've seen also at Facebook, they've frozen hiring. Google perhaps is a little bit more robust than some of the others, but if even Google is struggling in this situation to carry on the same pace of hiring that it was before, it means that companies further down the food chain, like Facebook, like Twitter, are going to find things even trickier. So it doesn't augur terribly well for that advertising market.
Alex, thanks very much. Bloomberg Quick Takes, Alex Webb with the latest on some tech themes this morning. Coming up on the programme, we will get back to thinking about that inflation print. Will it be a 41-year high for US inflation later? We'll talk to Sandra Horsfield, Investec senior economist, that coming up shortly. And Gary Shilling, president of Gary Shilling Co and author of The Age of Deleveraging. We will speak to him shortly. Plus, the cautionary tale of 3 arrows, how betting on rising prices below blew up the hedge fund and set off a crypto contagion. Read more on today's Big Take story on Bloomberg.com or by typing NI Big Take into the terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. We are simulcast on radio and television. I'm Matt Miller in New York with Kailey Leinz, Anna Edwards with us out of London. Now, we are focused on CPI today. Just 3 hours and 12 minutes until that number comes across the wire. And last time we got a CPI readout, it ended up in a cascade of risk assets. Ven Ram joins us right now, Bloomberg MLive currency and rate strategist, to talk about, really, this is behind everything, including parity in the euro to some extent, right, Ven? What do you expect today?
Absolutely, Matt. I do think that we may get a slightly higher than forecast inflation reading. And if that happens, I think that the front-end treasuries will sell off a lot more than back-end treasuries. I think the back-end treasuries are approaching the peak of the cycle. And what that means is a higher, faster CPI print will propel the dollar even higher towards 110 on the DXY. And that, as you mentioned, will feed into euro weakness, further euro weakness. And we have been flirting with parity level for the euro dollar for a couple of days now. That hasn't happened, but it may just happen after the CPI.
Yeah, I'm not falling for that 2 days in a row, Ven. We were watching it tick by tick yesterday, and it just didn't get there. We'll learn for next time. Let me ask you about US stocks then. In that context, Ven, I know that you've been looking at how cheap or otherwise US stocks are and whether they get any cheaper.
I think that they are pretty cheap, but they will get cheaper. If you look at the earnings yield on the S&P, we are now around 6%. So investors get about 3 percentage points higher than the 10-year Treasury yield. And that, if you look at the Fed model, the traditional Fed model, that would suggest that stocks are cheap. But I do think that based on my calculations, which are available on the terminal, I do think that stocks have further downside. Specifically, I think that the S&P has a downside of about 7% from current levels, and the NASDAQ 100 about 10% or slightly higher than that.
Okay, so Ven, if there's downside for stocks, how much more realistic upside room is there for the dollar as we talk about this broad-based dollar strength?
I think there's there is considerable upside for the dollar simply because you've got a scenario where the economy is going to slow because of the Fed's tightening. But at the same time, if inflation continues to be high like this, as you mentioned earlier in the program, we thought that the peak inflation was in March, but the June numbers negated that idea. And if we are going to get successively high inflationary prints, the Fed is going to keep going. And in that atmosphere, the dollar is going to get stronger simply because of real yield differentials are going to favor the dollar and propel it much higher from here.
Ben, thanks so much. Bloomberg's Ven Ram from the Bloomberg Markets Live team. And if you want more market analysis, check out Markets Live Go, MLIV Go on the terminal. As Ven said, he's been writing about valuations on US stocks. There's a lot in there on US CPI as well as we wait for that data. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Inflation in the US probably set a new 4-decade high last month. According to a Bloomberg survey, the Consumer Price Index probably rose 8.8% from a year earlier. That will keep the Fed on track for another big rate hike. It's all about oil. President Biden is on his way to the Middle East, where he'll try to persuade Saudi Arabia to boost crude output. His first stop will be in Israel. And Twitter takes Elon Musk to court over his scrapped $44 billion buyout. The company accuses the world's richest person of having buyer's remorse. Meanwhile, Google is putting the brakes on hiring. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. European equity markets then, Matt, caught negatively today. US stocks sort of pausing for breath, I suppose. Modest gains in futures, waiting for that probably maybe, or whatever it was I just said about US CPI. Probably it'll be 8.8%, I think is the forecast.
It likely probably rose to that level. And if so, you got to wonder how investors are going to react, because when we got the 8.6% reading at the beginning of June, markets collapsed. The S&P futures right now up about 0.3%. We'd still have to wait just about 2 hours and 59 minutes until that number comes out. So watch for the CPI. Obviously, surveillance is going to be all over it. The 10-year yield coming down right now to 295.95. It's not a big move, but investors may be preparing for that release. And NYMEX crude is up 94 cents, but that's after the big drop we saw yesterday. Oil was down like 7% yesterday on recession concerns, and especially if we get a higher print in inflation, the Fed's really going to be focused on fighting that rather than worrying about a recession. Bitcoin right now at 19,851, so up a little bit from midnight. The interesting thing, as I was saying earlier, is the last time we got an inflation print, June 10th, I believe it was, Bitcoin was trading around 30,000 and it fell to 20 within 4 trading sessions, so dropping by a third. If it falls another, well, $10,000 increments are what we have been seeing. So if we get a big inflation print, you could see it pushing down to 10 before it goes to 30. Kailey, what do you see in terms of pre-market movers?
Well, of course, Matt, that would be in line with what our MLive Pulse survey respondents said. About 60% of them said it was more likely it'll go to 10K in the near term than 30K. So that's something to consider. As far as the action in pre-market trading, of course, we continue to monitor the saga still playing out between Twitter and Elon Musk. Twitter officially filing suit yesterday. No surprise, trying to force Musk to see through that $44 billion deal to buy the company. Twitter shares are up about 1%. And of course, elsewhere in tech, we've been keeping an eye on the Alphabet story, specifically Google, which is slowing its pace of hiring for the rest of this year due to the economic headwinds that it says it is not immune to, that all companies are facing. Still, that stock higher by about 0.2%. Another story to watch is Novavax. Politico reporting yesterday that the FDA could grant emergency use authorization to its COVID-19 vaccine as soon as today. So that stock is higher by nearly 2%, as is Delta Airlines. It will be reporting before the bell today, so just a couple of hours from now, but it actually rose 6% yesterday after positive guidance out of American, that kind of lifting sentiment for the airline industry overall. So we'll have to see what those results actually look like, but that stock up about 1.8% before the bell, Anna.
Kailey, let's have a look at the European situation then. The picture looking pretty negative here, but really it's a little bit of a backward-looking story, reflecting some negativity on Wall Street yesterday. So European stocks making moves lower. In fact, most sectors in negative territory. We have 4 sectors moving higher. Real estate is the best performing sector here in Europe today, but that's up by 0.9%. Autos and auto parts, the worst performing sector. That weighs on the German market. Let me take you through a few of the currencies in focus today. We've got the pound, of course, in focus because we've got GDP data earlier on from the UK, which actually looked pretty good on first glance. A few difficulties in interpreting it because of the movement of a public holiday we should keep in mind. And of course, Eurodollar in focus because we spent a lot of time yesterday on parity watch. We didn't manage to make it to that parity party, but we will certainly keep that under review and certainly keep that in focus as we look ahead to the US CPI data a little bit later on. What will that do to the US dollar and indeed other currencies beyond? With that in mind, let's move on our conversation and talk to Sandra Horsfield, Investec senior economist, who joins us here on set in London. Sandra, very nice to speak to you this morning. And let me get straight to that US CPI print. What is at stake for you then when it comes to this CPI number that we're expecting to see today?
I think the main focus will have to be not just what headline inflation does. We know the energy impact will be large and visible, but what happens to core inflation? That is really the crux of the issue. The Fed is keeping a very close eye on this. It's the core price pressures that they can affect through their monetary policy, and therefore that will be the main focus of the market.
Yeah, I mean, often we say, 1 month's worth of data, maybe we don't get too excited about what that means, but we saw this time last month, the CPI print had a real ability to influence the Fed's thinking. It led to a whole lot of Fed communication and a resetting of market expectations and delivered a 75 basis point jumbo hike. Do we expect this to be quite so market moving?
In our view, for the time being, price pressures are still very strong. We haven't quite seen the sort of effect that is large enough to bring about a big cooling in the US economy. We think it's coming, but not quite yet. So further actions on the brakes is likely to be necessary. Just how much? Well, the CPI prints and others are key to watch.
Okay. So you don't think that the US economy is currently in a recession?
For the time being, we're not quite there yet. We're heading in that direction. There's some signs of cooling. Certainly, if you look at the housing market in particular, the rate rises that we're seeing are starting to make a difference, and we expect that to continue. But overall, rising rates are designed to and will deliver a slower economy. We think some recession is inevitable.
And I mean, GDP contractions in Q1 and Q2, does that not concern you?
Well, as I said, some of it is deliberate because it requires some slowing in demand to bring us back in line with supply to affect the price balance that we're seeing. And that's what's necessary. We have inflation far above target, and these inflation expectations are starting to rise and will have to be brought back under control. Some recession, perhaps, is the price to pay to achieve that.
And what level of unemployment would that take, Sandra?
It's very difficult to say. I think we have to bear in mind we're starting from an incredibly tight labour market historically. So we've come out of COVID in a remarkably good position. And that's, of course, a welcome sign. But it does mean that the risk of second round effects in wages are that much greater. And so how hard do you have to step on the brakes? It's very hard to tell and very hard to calibrate ex ante. I think it's a matter of watching how the economy responds and then being able to let down and probably reverse some of the tightening that we're going to be seeing now.
Do you think that reverse comes in 2023?
Most likely, yes, it will be 2023 by the time we get there. Unlikely to be as soon as this year. But of course, much depends on, as I said, just how quickly we get that overall broad response stretching beyond that of the housing market.
Sandra, we got some data out from the UK a little bit earlier on, GDP. It was just for 1 month, and it's a little bit difficult to compare this year with last because of the movement of a public holiday. But the data looked much higher than the market had anticipated, growth of 0.5% in the month versus expectations of some contraction. Did that materially change your view, or are you focused on the downside risks?
It's very hard to be disappointed by a number that was so strong and so broad-based as well. We have not just a high headline print, but manufacturing was strong, construction was strong. All of this is a positive sign. And even the consumer sector only contracted very slightly, which is quite remarkable in the context of the cost of living crisis. That's likely to add to the pressure for the Bank of England to be forceful, as they had indicated beforehand. So the risks of more aggressive tightening in the near term, perhaps reversal later, are growing.
And for broader Europe, Sandra, finally, how much is the trajectory of the European economy, even the euro, as we talk about parity, going to be influenced by ECB policy when there's a threat of a shutoff of Russian gas?
This is clearly the number one risk facing the economy in Europe at the moment, and one that policymakers are very much aware of. It is, again, the same situation in the sense that we're dealing with a very tight labour market. How much compensation will consumers demand for the very high cost pressures that are coming? How much will the government be able to offset? All of this will play into it. It's not just the fact that activity will slow down, but the wage response and how much policy action from the ECB is required as well that will play a part.
Sandra, thanks very much. Sandra Horsfield of Investec. We'll keep focused on that gas story that Kailey mentioned, of course. UBS putting out some really interesting research talking about stocks dropping 20% and the euro going to 90 US cents if we saw those taps remaining closed. Now, coming up on the programme, we will talk to Gary Shilling, president of Gary Shilling & Co. and the author of The Age of Deleveraging. He has some gloomy thoughts. We will try and find out if they are all gloomy thoughts about risk assets. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Cleveland Fed President Loretta Mester. That's at 6 p.m. in New York, 11 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. Now, more on today's main event. The U.S. inflation print is due out at 8:30, so just about 2 hours and 48 minutes from now. Joining us to talk about that and the implications is Gary Shilling, president of Gary Shilling. He's also a Bloomberg Opinion columnist and the author of The Age of Deleveraging. One of the big bears that we've been talking to for many years about, well, I was telling the ladies earlier that you've called 30 of the last 10 recessions. Is that fair to say?
Oh, come on now.
Gary, do you think that we're in a recession now? And I know that we have to wait for the official declaration by the NBER. That could take, months and months, even a year after a recession before they officially call it. But it looks like we've had two back-to-back quarters of contraction.
Well, yeah, that's kind of shorthand. But if you look at stocks are down, you look at the yield curve is inverted, you look at confidence, consumer confidence is down, you look at the small business, you look at all these indicators, and I think it tells you we're in a recession. And obviously it depends on how you define it. But I define it as a contraction of business, and stocks are one of the best leading indicators of that.
And the S&P 500 is down 20% year to date. We heard from Michael Burry that was just valuation contraction. And now, this earnings season, we're going to see the margin contraction. How much further do you think we could fall?
Yeah, I think we're about halfway there.
Halfway?
Yeah, I think we're about halfway. And I think for those reasons, you've knocked the fluff off, and now you get to the guts with earning contractions. And bear in mind that we've been floating really since 2008 on a sea of Federal Reserve money, and it's created a lot of speculation out there. You look at Bitcoin, you look at GameStop, you look at all these things that have collapsed once you take this away. Growth stocks, when you get high interest rates, their present value is worth less. A lot of things are really reflecting the idea that you simply do not have all that money from the Fed, and of course, all the fiscal stimulus money that came in reaction to COVID.
Okay, so if you think we're only halfway there when it comes to the stock sell-off, you probably don't want to be a buyer of stocks right now. What can you buy?
Well, you can buy Treasury Bonds, which we're long. You can
Even though the Fed is hiking aggressively.
Pardon me?
Even though the Fed is hiking aggressively, now is the time to buy Treasuries.
because what happens is the Fed normally switches to ease once they've done the recessionary deed, and markets even anticipate that. And I think the Treasuries are beginning to see that. And of course, you get the fear aspect. It isn't just what the Fed does. And if you look at the 10-year, it's already estimating a 4.5% Fed funds rate if you look at the normal relationship. So I think you really had Treasury notes, and I'm a devotee of the 30-year bond, as you may know, because that's where you get the bang per buck when rates go down. Of course, it happens to reverse when they go up. But I think you're already seeing that switch. We're also long the dollar. We're short copper. I think commodities are in trouble. And I like copper on the short side because there's no cartel on either the demand or supply side. It isn't like oil where you worry about OPEC and Russia, and it goes into almost anything manufactured. So those are sort of the things that I'm interested in, and we're short stocks. We're short the S&P.
And you mentioned the pricing of the Fed terminal rate that's in the market right now. Do you realistically think the Fed can get there given the kind of economic environment you're describing, the slowdown we're already seeing?
Well, these guys have a credibility problem. They were behind the curve. They were very slow in coming to the party. And they're among all other central banks. These guys move talk about cartels. These guys move together. And yeah, I think so. They got the bit in their mouth, and they really are worrying about their credibility. And they're out to slay the inflationary dragon. We like to think otherwise, but they don't have paramount concern with what happens to the stock market.
Gary, good morning from London. You talk about being, well, you like the dollar. You're buying the dollar right now. How long does that dollar strength last? If we're halfway there on stocks, how far through the dollar move are we?
Well, I think the dollar has a long way to go. If you look at where you were back in 1985, for example, we're still well below that. And the dollar is a safe haven. Also, Treasury yields are higher than they are in almost any other developed country sovereign. So investors pick up a yield spread and also a translation gain when they move into Treasuries. And you got to be in the dollar to get there. So I think the dollar has got a long way to go.
At the same time, we saw the euro almost touch parity yesterday, just fractions away, and the pound was down to 118. I heard a British former advisor to Her Majesty's Treasury yesterday, Ed Brice, tell us he thinks maybe not now, but longer term, we could see the pound go to parity. Is dollar strength going to be that serious, or pound and euro weakness?
Yeah, well, it's a combination of both, of course. There are two sides of any currency trade. But bear in mind that the euro was well below par when it started in 1999 and early 2000s. So this idea...
I bought a car with the euro at 88 cents, I will point out.
Okay, all right, living example, Matt, living example. So I don't see any reason why I can't. I mean, currencies, there's a lot of implications, and it isn't just the markets that we live in. It's a whole of commerce that's involved with this. But I don't see any reason why you couldn't go back certainly well below par on the dollar. And the euro, again, the euro has virtually collapsed.
Yeah.
Gary, thanks so much. Thank you very much for joining us. Gary Shilling of Gary Shilling Co. getting up super early for us in New York. We appreciate it. Coming up on Balance of Power, we will discuss the U.S. inflation numbers with White House Council of Economic Advisors, Cecilia Rouse. That's at 12 p.m. in New York, 5 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance, who will be breaking down the CPI data at 8:30 a.m. Tom, happy CPI Day. What is your single best chart for this Inflation Wednesday?
Well, it's maybe the chart of the year. It's on America, but it could be on the world, and it's about the separation of goods and services inflation. We've showed it many times. We get an update here on a good Inflation Wednesday. Services inflation always higher than goods inflation, even goods deflation from time to time. Over the years, up we go, and the yellow line is the goods inflation exploding higher. We all know this. I mean, you got the used Bentley, Kailey, and you know what you paid for that. 8.8% is where we are now. Goods inflation rolling over. Will it roll over? But the real important point in that chart is how does services inflation roll over?
And roll over, it is, or at least we're seeing it already in goods. Gary Shilling just joined us here, and he says he's already making investment decisions based on the Fed turning back down. Are you hearing more of that, Tom, that people are starting to really place their bets that the Fed's going to be reducing?
I think a lot of people are doing that, not everyone, but yes, I think that's out there, Matt. But the importance is Dr. Shilling is absolutely the definitive person in the world on deflationary and disinflationary trends. He's got the Blue Book out years ago. He gives me royalties. I've sold so many copies of it. But Shilling's book, Deflation, is the definitive Bible on this. The physicist from Amherst is just lights out on price change.
Tom, thanks so much. Tom Keene with his take on the inflation data still to come, and indeed some of the voices that we have heard from. And we'll continue to hear plenty of voices, of course, on the US CPI print as we get towards that data and beyond. I was interested, team, in what the Bloomberg economics team was saying. They were talking about how some of the forward-looking data, and this chimes with your point, Matt, some of the forward-looking data that they see already suggests that there are downward forces working on inflation, but they think the Fed stays the course and continues to hike into that, which does raise interesting questions about the psyche around inflation and how far through the process of getting that to be entrenched we are, which is something the Fed is really worried about.
Well, and this is what Gary was saying as well, that the Fed has a credibility issue, right? They can't, even if inflation comes in lower than the estimate today, they can't be seen as getting off the brakes too soon. And if they only do 25 or 50 basis points rather than 75, not my take, a lot of people have argued this to me, they'll be in trouble if we get a higher inflation print next time. So they have to do the most that they can in order to show that they're on the case. Kailey, don't you hear that from people as well?
Yeah, that's definitely what you hear, that the bar for the Fed to blink is just that much higher, considering they're already behind the curve, and they want to make it clear that this is their priority. Labor market mandate aside, inflation is really what they want to tackle. And Anna, to your point about some of those forces coming in to push inflation down, we have to keep in mind we're talking about 8.8%. The Fed wants to be down at 2%. The question is, how long does it take to get there? Because even if we see a deceleration in price growth, prices are still going up at a rate that the Fed is not going to be comfortable with.
Yeah, and Kailey, they say they want to be laser focused on inflation. And we remember what happened last time when we got the inflation print and what that did to the Fed's expectations. We need to be alert to that, I guess, given the extent to which the number beat last time and what that did to the Fed's communications. And suddenly we were hit with the jumbo hike.
Does everybody want to be laser focused? Is there any other kind of focus besides laser focused? That's everybody's laser focused, right?
It's just, you know, it's really to emphasize the focus. It's not just focus.
And by the way, I'm looking.
Effective shorthand.
We're sitting next
I'm
to
sure
each
Matt
other,
can
so
think
I'm
of at least 3 or 4 things.
I keep hoping for a wide shot. Anthony, do we have a wide shot? Is there a wide shot?
I'm always in the
No,
way.
I guess not.
I'm
Yeah,
just
sorry.
in the way of your wide shot. That's the problem. Right, that is it for Early Edition. More surveillance is ahead. Tom, John, and Lisa will continue to be laser focused on the inflation print, which is due out in the US a little bit later this morning, of course. Global markets, no doubt, focused on this number. What will it do to euro dollar? There's one asset to watch. This is Bloomberg.